All right. Welcome everybody to Midas Investing Live. Hope you're all having a good Sunday afternoon. I know I am. Hope you all have had a good week. I definitely did. Did a lot of work on our spreadsheets here, which is definitely what we're going to be talking about today. Some changes that are probably pretty unnoticeable. Anybody who pays attention to this dashboard would notice right off the bat. We have a little bit of some differences in how I'm showing the targets here, which I'll get to explain to in a little bit, as well as some different eyes and charts, and that continues down here as well. We did already have this one here, which showed our overlap with the S&P 500, but I did add some pies here to show my commodity exposure as well as my foreign exposure, foreign entities anyway, which again, we'll get into some of the more specifics of that. Already had the size pie here, but then I've always showed my portfolio beta here, which is my actual monthly returns against the S&P total return, which is how I calculate my beta, which is the 0.92 that's right here, which is the alpha estimate is actually right here. But I also included now a pie to show the distribution of the betas of the actual items within the portfolio, the actual securities. Technically, it's only including the common securities, not including the ETFs or anything like that. And it's just kind of a little pie to kind of show the distribution of it, which will kind of like right off the bat, you can see that more than half of them is between about 1 and 1.5 of a beta, so relatively high beta, but not necessarily extremely so. A decent amount with much higher betas, and then decent amount and much lower betas. And then, summarizing the other ones, commodity exposure, you can see I have about 13% exposure to commodities. To be specific, this is companies that produce commodities, commodity companies, as well as any direct commodity exposure. So this would include my lumber producer, as well as my gold producer, as well as Tyson, which produces beef, chicken, and pork, as well as it would include my copper producer. And I also have the ticker BAR, which is a gold trust ETF. So I do also have that included in there as well, since that is direct commodity exposure. So 13% is my direct commodity exposure, and then 87% in non-commodity related securities or other exposures. And then the foreign entities, to kind of explain that more specifically, this isn't all foreign exposure, because you could break it down by like sales per each company or something like that, or by assets. This is specifically which portion of the weights from securities that are actually direct listed in other countries. So this would include InMode, this would include Barrick Gold, this would include Interfor Forests, all of which are domiciled corporately. Their headquarters is in another country. But I did also choose to include in this slice any company that I know for a fact has more than 50% of its revenues or its operating assets in another country as well, because then I'll basically say that while they may not be domiciled in our country, they do have substantial risk associated with operating in a country like that. So examples of that would include my copper producer, Freeport-McMoRan, which is an American domiciled company, but has the majority of their assets and revenues coming from other locations other than the United States. And then that would also, funnily enough, apply to Meta, of all companies. So that's actually technically included in there as well. So those are the only ones that are included in that 14%, but that's the 14% right here. The other 86% is US companies or companies that substantially have their assets and revenues coming from the United States. So just listing these exposures, which we'll get into those, understanding the differences between those categories, as well as some of the other things that we discussed that are kind of listed here, is relevant to the kind of topic we're going to be talking about here today, which is to say that I have gone and changed my allocation system again. Now, people who may have watched these live streams a lot over the year might be like, wow, Derek, haven't you changed your allocation system like twice this year already? And it's like, yep, well, I did it a third time. And like with the other examples, the reason why I chose to readdress it was that it wasn't quite satisfactory enough. My most recent system, sorry, hold on a second, I had a very loud noise outside. I assume you guys actually probably couldn't hear it, but maybe you could, maybe you couldn't. But at the same time, I didn't want to talk over it. But anyway, so with my previous changings of my allocation system, I had changed from a somewhat complicated, more dynamic system that I thought was a little bit cumbersome to try to keep track of, to a system that really just had a few key check boxes for each company to decide on certain risk measures that would decide on its allocation system. And I kept that system in principle somewhat similar, but I chose to rearrange it, both to make it simpler, with less factors to have to decide for each company, because I still wanted to make it much simpler. I thought it was still too complex. And then I also changed it into a range, which you can kind of see here, which I'll start to explain in a moment. So instead of having just a one number that I'm targeting, I chose to target a base level as well as a cap level for each space. So that the base level is the level of which I'm trying to buy up to, at least as a minimum, and then the cap level is the point at which I'm very seriously considering that I need to lower my position, sell out of some of it. And anywhere in between, I'm willing to hold. And maybe buy more, maybe sell a little bit within the in between as well. That's a little bit contextual, but it's more of a guideline as a general rule. It kind of depends on the individual company. But the point is I made different factors affect the base level, and different factors affect the cap level. And the reason why I did this is because I didn't want to have my cap level, which includes thinking about the capital appreciation that I have on the security, be affected by some of the base concerns I have for the company. And also, in my previous, most recent new allocation system that I had made, I had described how I had included a momentum factor, where I was going to let companies ride a little bit whenever they were in positive momentum, rather than cutting appreciation too soon, so to speak, while a company is still riding very, very strongly in that momentum pattern. And so I still liked that idea in principle, but the point is I didn't want it to be changing. I didn't want momentum to be deciding how much I was going to be buying into a company. I only wanted it to decide how much I would be selling out of a company. So that one way in which I was doing this is I have the momentum factor affecting the cap, but I don't have the momentum factor affecting the base level, if that makes sense. The base level is affected by things like whether or not they are a foreign entity, whether or not they have commodity exposure, as well as whether or not they need capital requirements as well. We'll get into some of those factors in a little bit. Whereas the top level, the cap level, as I was saying, it includes a momentum factor, but it's also affected by whether or not I think a specific security is overvalued, or has higher or less expected returns relative to the market, which is, more typical decisions about when I'm going to be buying and selling something. So I have this designed to automatically drop the cap level I'm holding whenever a company becomes overvalued more and more, as well as when it drops out of momentum. So taking a look at this, you can see where the positions are. And I had rearranged it based off of these assumptions, also based off of some other factors, which we're going to get to shortly, which is partially where the title of the episode comes from, categorizing the companies, because we are indeed going to be doing some categorizing for the companies, just beyond the commodities and the foreign entity aspect. We'll be doing a little bit, I guess you could say, my proxy for thinking about whether or not I have a value company or a growth company, or something like that. I decided to kind of create my own way of categorizing companies, which we'll get into shortly. But that's also decides some of the factor upon which the allocation system is designed. But you can see the results here. The results is what I particularly want to point out to, is that the companies, for example, that you can see I have larger allowances for allocations for would be FG, PayPal, Generac, and InMode. And well, I mean, I have videos on all of those, but anybody who's watched all those videos, you might be able to figure out what those companies have in common, which is to say that they have pretty large opportunities in front of them in terms of growth of their actual main business, their fundamental business. Different industries kind of all around there. But that's something I kind of want to point out here, is that the new allocation system is very much designed to skew more towards companies with larger opportunities over the next decade for growth. I'm trying to really skew a little bit more towards those opportunities. That's not to say that they have to be doing some super huge growth play necessarily. We'll talk about what I mean by growth here shortly. Like I said, this comes down to the categories. But I wanted to kind of create my own version of, I guess you could say, value versus growth, or because I've never really liked those distinctions. We'll get into that shortly, but like in general, the kind of academic description of a company that has high growing revenues or high growing EPS over time relative to its possibly being overpriced, versus value companies, which are generally seen as underpriced relative to their current cash flows. So I wanted to kind of create my own distinction of that because I never liked this distinction, since as far as I'm concerned, some companies are both of those things and other companies are neither of those things. So it never really made too much sense to me to like specifically bifurcate by a system where you could have overlap between the groups. Anyway, getting a little bit ahead of myself, but anyway, pointing out some of the other results, the newer kind of allocations, as you can see, that would indicate that I definitely have some buying to PayPal to do, at least get up to my minimum level. It would indicate that my FGE levels are not too extreme at all, but I have bought up at least kind of a good minimal level. The rest I could just leave to capital appreciation, but hey, I could maybe add a little bit more FGE theoretically. It would imply that maybe I should trim a little bit of Smith & Wesson after the most recent run up. I might hold off on that just because this allocation system was put in place after I bought into that system. But we'll see if it lasts long enough in that space, then maybe I will decide to act on that. I am overweight on a few of the other positions as well, including my bond positions, or at least two of the three out of or three of the four of my bond positions I'm overweight on, as well as a little bit overweight on Barrick, a little bit overweight or significantly overweight on Tyson, and I think that's about it. And then, like I said, I am also still underweight on Generac, but I have partially hadn't bought as much Generac so far because my previous allocation system wasn't really giving it a very good allocation size, and I was trying to stick to my allocation system while still buying Generac whenever the opportunity arose, and I was having difficulty finding opportunities to arise where the allocation system was agreeing with it. So hey, you could say you change your allocation system so that you could have it suit your needs. We'll see, but like I said, the point is ideally I'm trying to find a system for allocation that I don't have to change much eventually. Like once I find something that is good and settled, the goal is to not really have to change from those principles. So the current new setup says that maybe Generac is indeed worthy of much more allocation, but again, we'll get into the reasons why, which has to do largely with opportunity. We'll get into that. It's not necessarily about revenue growth, it's about opportunity, but we'll get to that. In mode also seems to be implying I should be buying at least a bit more to get up to that base level. Again, you don't have to fill up to the top level because the top level is supposed to include capital appreciation into the number a bit. But the base level is where I'm supposed to at least be buying up to. So if I'm underneath the line there, it implies that I should definitely be buying up to it. So yeah, pretty pleased with the new allocation system, at least where it currently stands. Like I said today, it's one of these things where it's like you make the allocation system and you kind of check it against what your assumptions are in your mind about what you think things ought to be. And so it looks nice today. The question is after 2 to 3 months of activity and moving things around, am I still going to be pleased with the setup as it currently is? So we'll see where that lands in the future. Other minor changes. I previously didn't have a slice set up for companies in here that don't have full models on them and are done more on either a pricing based kind of set of assumptions, or possibly a merger arbitrage play, a workout of some sort. And so I currently only have a couple companies that fit into that mode, specifically Jackson Financial and Spirit Airlines, one of which is a workout and one of which is just kind of like a relatively short-term pricing play without a full model built for them. But the point is that you can't really see it right now because the slice is too small. And I think I actually forgot to list Jackson as it. Yeah, because otherwise this wouldn't be there. But the point is there is an extra slice that's in this pie. It's just so small that you can't see it currently, but there was technically a small change made there. So coming down the line, there hasn't been any other changes to the other things down here. The return stuff, that's all still the same. And as far as where we are in terms of returns, it looks to me like we've been maybe catching up a little bit with the small cap index. More like the small cap index has been dropping much more than we have, but still kind of lagging both of those markets. Is what it is. Full upfront about that the benchmark rate is what it is. But I definitely am of the mind that we could see some downward movements in the overall market, meaning the S&P 500. Obviously, we had a pretty rough week this last week. A little bit of some zigzagging, but in general, definitely some slight downward movements, as we can kind of see. Maybe that's the start of something. Maybe that's just a brief pullback and we're about to take another leg up. I personally am still in the camp of belief that we are not going to escape the high interest rate solving of the inflation scenario without a recession, but that's kind of another topic, and we'll get to maybe some inflation talk a little bit in the near term. Mr. Beast, what am I saying about Express? I haven't been saying nothing about Express. I know we were talking about it a little bit in the Discord.
I wasn't kidding about the fact that I was shopping there not too long ago, but back to school shopping and whatnot. But today we're mostly talking about allocation systems. We'll talk about some companies a little bit in the back half, but I've talked about Express a few times already. I don't think I'm going to talk about Express on the live show today. I am maybe interested in maybe doing a valuation at some point, at least a basic one. I know I haven't got around to it yet. So if I ever do get around to doing that, don't worry, I will bring it up in the live stream so that you can get the rundown on it. But not yet anyway. I haven't gotten around to doing that. So we'll see. Why? I mean, like I said, because I've talked about it a couple times before. But like I said, maybe if I don't have too much else to talk about in the back half when we're talking tickers, maybe I'll bring it up then. But at least not right now, because like I said, we're talking about companies and my company categorizations and stuff like that. So coming over to the main dashboard page, well, at least for the portfolio holdings, this kind of gets us started on the subject here. I know like the text is small for a lot of people that watch it. We'll be taking a look at it. I generally have always kind of listed the two kind of categorized camps that I had here, which was in general, I had an asset type version of categorization, which we saw, you generally saw in this pie right here, as well as I had a strategy categorization, which I was just kind of remarking on a little bit, which is valuation versus macro versus hedging versus pricing and workouts, which was also, like I said, listed in this part right here. So the new kind of setup for kind of categorizing companies, I haven't put on this this spreadsheet right here where it kind of lists all of my actual positions in column format. But I did at least kind of put a separate page where we can kind of discuss the general idea of it. So coming over to this page, we can see kind of where I put together the data that puts together for my targeting system. So like right here, I have the actual weights for each of my positions. And then here I have those targets that I was showing on that other graph. This is the base level, and then this is the cap level. And then over here in on these columns, and we'll talk about the right section a little bit first. You can see that we have where it's list commodity, foreign, and capital needs. So this is where I list whether or not it is one of those commodity companies, whether it is one of those foreign companies, or whether or not it requires future capital influxes, whether it's through massive amounts of debt issuance or through dilution of their stock issue. It doesn't really make a difference. That's another factor that I am adjusting for risk wise. I just didn't make a pie for it because it's not really going to be one that applies to a lot of companies. For example, the only company it applies to currently in my portfolio is Spirit Airlines, because I see them as a huge bankruptcy risk if their corporate workout doesn't go through. But though I also do only have a position in them because of the corporate workout, so that's one thing to take into account. But the point is yeah, so these are three risk factors that I want to adjust my base level of targeting for each of these companies for, which is to say that these risk factors mean that I don't want to have a large exposure to them from the get-go, just because of the fact that they have these concerns. Commodities, you can't control the pricing for it. You can only control your production levels, and your production levels themselves are going to drive the profitability based off of the macro driven price levels. So both your profitability and your revenues are entirely driven pretty much out of your hands when it comes to being a commodity company. You can only decide your production for the most part. So that is a major risk. And then foreign companies, given that I am a United States citizen and a United States shareholder, that means that different political entities are likely to back different citizens of different nations at different points in time whenever it suits them, whenever the economy goes south, or whenever they're in a crisis or some form. So operations that are significantly backed in another nation, whether it's because they're corporately domiciled there, or whether it's because they just have large amounts of assets operating in other countries, that creates excess risk. So we're going to limit our allocation size based off of those risks. And then, like I said, capital needs, that's just another extremely large risk. In fact, this has a pretty disproportionate effect on the allocation system. So that's why Spirit has a pretty low base target in general. But this would also apply to any more speculative position that I might take on. One that comes to mind on the valuation dashboard that we've talked about a few times before is Urban Grow, Ugrow, a company that I think has a pretty interesting opportunity in front of it, but I also think has massive bankruptcy risks associated with it if it's unable to get the capital that it needs in order to make its opportunity a fruition. So the point is, you would want to discount your allocation to a company like that based off of the fact that it has such huge bankruptcy risks. And so if I was to take a position in that, I would definitely check this box for that company as well. But then over here, like I said, I have valuation as well as expected return, as well as a momentum factor listed. And it's basically just using a logic check to see whether or not the company applies for those metrics, and then those metrics affect the cap level, not the base level. So it decides just how large the total size I'm allowing it to go up to include, which, like I said, includes capital appreciation. So this center section, which we kind of skip past, I kind of already talked about the type and the strategy. Those are the same as they were on the other column listed data for the portfolio. But then there's these other two columns right here where I have listed past profile and future profile. Now this is where we get into the categories, as I'm talking about the new categories I have for my companies, which is why, for example, you can see here it's only listing it for the ones that actually have valuations or are pricing workout options, because it has to be a normal common stock for it to apply to these companies. It has to be a company, not an ETF or an option or something like that. So when I'm talking about past and future profiles, what I'm specifically talking about, as I kind of already hinted about, is that this is related to the opportunities the company has. And as I was saying before, I don't want to bifurcate my portfolio based off of value versus growth, because I've never really found those categories to be very satisfying, since they overlap in different ways, as well as can be non-exclusive or non-inclusive of each other, even at different points in time. So the new way in which I chose to categorize my companies is not based off of the revenue specifically, or the value of the stock specifically, or anything like that. I'm choosing to categorize it specifically off of the volumes of the business itself. Whether it's a product or service doesn't make a difference. The volumes of the products and services that they sell. So it's sort of like revenue growth. It's sort of like growth, but it's not really thinking growth in particular. It's more taking pricing out of the question entirely too, because we're going to say that pricing is a factor of market share and market strength, competitive advantage. So volumes is specifically the way in which we're choosing to bifurcate our companies. So coming over to Canva, which I use to make my thumbnails and stuff, but I chose to make a little graphic on here because I can move them around relatively easily. We'll kind of show exactly what we're talking about. Arts in the chat from Twitch. Hello to you too. But yeah, so coming over here and we can take a look at it. I chose to use the political compass image as my way of categorizing the companies. Take that as nothing more than a joke. There's no association to any political ideologies related to these companies or these strategies or anything like that. Like I said, it's just a compass, and I just chose to use a political compass for the means. But anyway, we have 4 categories that I chose to put it into: increasing, cyclical, flat, and decreasing. Obviously, increasing and decreasing are opposites of each other. Cyclical and flat are not necessarily opposites of each other. They're just contrary ways of acting. And we'll kind of get into the way I'm thinking about this. Now, again, when I'm talking about these categories, think in terms of the volumes of the company's products and services that they sell, not the actual revenues and sales that they take in, or we're taking sales out of the question. And now the reason why I have at least an understanding of for all these things is, like I said, I built models for all of these companies, or at least all of them except Spirit, yeah, and Jackson. Like I said, I haven't built full models for those ones as well, but I have at least looked at their volume, so I at least have a general understanding of what's happened within their business on that level. But the point is you have to take a look at their volumes, and then coming back over to the little dashboard, as I was saying, showing a moment ago, I had shown that we are looking at both past profile and future profile. So the profile I'm talking about is their volume profile. We're saying it's like, what is their volume growth been like over the last decade, and what is their volume growth been like over the future decade, based off of the model I built or based off of the assumptions I have for the company. So that's what we have right here. And then if they're kind of in the middle, that's because they're basically caught between one of these categories. You can see some of them were increasing over the past decade and are flat over the future profile based off of my assumptions. Some are increasing and are expected to decrease. Some are flat and are expected to decrease. Some were flat and are expected to be more cyclical. There's a whole variety of different ways things are moving around based off of, like I said, the volumes of the products and services that they're buying. And this is, like I said, one way in which I want to kind of think about whether or not the company at its core level is growing or not. And I want to put much more focus towards companies that have their base volumes growing. So you can see right here, we have indeed categorized the companies a little bit right now. You could definitely argue about some of the exact positionings of it. I didn't. Well, we don't gotta overthink the positions of it. You might be able to argue me into pushing one into a slightly different position. It's partially just also some of them are based off of some more conservative estimates than others. Others I have more confidence in, like, the growth path of others. The relative position of these doesn't necessarily mean too much either, because I had to kind of fit them all into this space. So like I said, don't overthink it. It's more of just like a general guideline. But like I said, for each of these companies, at least for both their past and their future, I chose to put each of these into different buckets based off of whether or not their volumes are growing or shrinking. And then the cyclicality one, I want to kind of point out what I mean about this, because you can kind of think about companies that are cyclical as possibly being in the increase mode. You could also think of them as possibly being in the flat mode or in the decrease mode. So the cyclical basically just implies that yes, maybe the revenues are going to increase over time, but they're likely to have to decrease first before they increase again, which would definitely apply to something like Smith and Wesson. And that would even apply to Fidelity National Financial, at least in terms of the title insurance portion of its business. Obviously, FG is in a different camp, and that's kind of part of F and F. So you can kind of see like between that, and then you can see FG. I kind of put a little bit closer to the line for reasons somewhat related to that. Meta, for example, has grown a lot over the last decade, but you could also argue that as they become more and more stable, they might start to become a little bit more cyclical looking because of the nature of their business. Interfor has grown a massive amount over the last decade, but it's possible that the production levels are going to start tapering off to a more flat level. And then you could also have argued towards putting them into the more of the cyclical camp too. So like I said, you could argue a little bit about a few of these positions. Like I said, it's just kind of a general feeling I have for these, and it's based off of the most recent valuations I've made. Like I said, it's like a lot of these has to do with the forward expectations that I have for the companies and the models I've built for them. And I also do double weight in terms of the way the calculations are being done in here. It double weights towards the future compared to the past, just so there's like there's actually a doubling in terms of how much this affects the target sizes that we have going on over here. So if we come back over to the actual image of the weight, so you can take a look at it as I had showed initially, and how, as I had kind of initially pointed out, was that the companies that have larger opportunities in front of them, at least according to my analysis and the models that I've made recently, companies like FG, companies like PayPal, companies like Generac, companies like InMode and FNF through FG to a certain extent, you can even see as well, have larger opportunities in front of them. So you should see larger allocations given to them here. But like I said, it is more based off of the volumes, not based off of pricing. So companies that I expect to have high revenue growth that are due to price changes, like say some of the commodity companies that I have exposure to, I don't necessarily give them huge allocations, because it may not necessarily be that they're going to start selling a bazillion more ounces of gold, for example. It might just be that I have expectations that the gold price is going to go up significantly over time, right? So that's the thing, is like we wanted to change our thinking about this, not from thinking about sales growth, but thinking about volume growth. Okay, so this is my new way of categorizing companies. I hope you guys like it. It says like I was trying to find something that I felt more concrete about, that does solidly bifurcate companies into different categories. You can easily be put into one of these buckets. As I was kind of arguing, you could kind of argue about being caught between two of the buckets, but the buckets are mutually exclusive. They're not, like I said, the weird concept between value and growth, where it's like you could be a growth company, but you could also be a value company, and you could also sort of be neither of those categories. And of course, you could argue that, well, right there, we just like labeled out 4 different groups. But the point is, I would argue that those groups don't actually have much related to each other. Growth is about revenues, and value is about price relative to profits, or price relative to book value, maybe, right? So all of this is about volumes, and I think that makes this logic a little bit more make sense. And I will say there's also one kind of natural factor to the way that I created the targeting system, is that I did, as I had kind of said, the goal is to kind of lean more towards this. So that means that there's obviously a ranking system implied here. So obviously the increased category has been given the kind of top rank, so to speak. And then I do actually categorize cyclical as rank number 2. Now you could argue about this. You could argue that maybe flat is better than cyclical. You could argue that cyclical is better than flat. I'm personally in the camp more that I would prefer cyclical over flat. And then my logic behind this is that cyclicality is often just the state that you're in between large upward increase movements. And then the cyclicality also creates interesting opportunities within companies. Of course, that requires careful and thorough analysis in order to take advantage of those opportunities. But the point is, I'm always, naturally willing to dive into the weeds on that type of thing. Whereas flat volumes companies, they might be considered stalwarts, that you might consider that like companies that have moats might look sort of flattish sometimes, maybe. In terms of their volumes, again, they're probably going to be moving up in terms of their revenues because their pricing would be good if they actually do have a monopoly. Again, we're talking volumes here. But I would argue that flat volumes is really just the bellwether, or the bell being tolled before you enter the decrease category, right? So that's why I'm personally categorizing cyclical as being ahead of flat, even though you could argue back and forth on that category there. And then also, like I said, as far as like the specific location on here, also, you could argue I'm being a little bit rude to both Spirit and Hibbett here, considering, like I said, Spirit has actually grown a ton over the last decade. And I'm just putting them in the decrease category partially because I see them as a huge bankruptcy risk. And so the way I look at it is either they're going to succeed in their merger, which is part of the reason I have shares in them, or they're going to have to take on massive amounts of new capital, probably through share issuance, or even taking on even more debt, which is going to bury their business. And then that would lead them to possibly having to sell off assets, which would mean decrease in revenues. So my long-term expectation for Spirit is pretty bearish, unless they can get their debt scenario under hand. So maybe it would be better to put them in the flat category, but I also kind of wanted to have at least one company way out here in the distance to a certain extent. So that is what it is. Mr. Beast is pushing Express more and more in the chat. Man, be patient. I'm working. We're gonna get there. Maybe. Somebody else has a special request ahead of you, actually. Unfortunately, I will say. But maybe I'll take a look at Express after I get through that part of it. But I am, for the most part, done with this discussion. So it was a relatively short topic to talk about here, so we can talk about other companies a bit more. So it is a shame that not as many people are here to chat. Just you, Mr. Beast, it sounds like, so far, or at least that's commented. Other than the other guy, we did have the gentleman from Twitch. I can't remember his name already, but he just kind of said hi. Hearts. There you go. Yeah, he said hello. But I don't see Jeff doesn't seem to be in the chat today, or any of the other people that normally suggesting tickers. Hopefully you have more tickers than Express, but we'll see. Get there in a minute. So yeah, next thing we'll talk about, well, I guess I'll do some slight finalizations on that here. So yeah, here's the new targeting system. Like I said, with that, obviously it's implied that I'm going to be buying more PayPal. I'll probably be buying more Generac. I've been kind of laxing on the Generac buys because I didn't like my previous allocation system. So now I definitely will be. I actually did buy a little bit of InMode this week. I'll probably be buying a little bit more going forward if it's on down days or something like that. And then, man, I wish I had bought more FG previously. I wish I bought more Smith & Wesson prior to its earnings. But like I said, I'm maybe over allocated now. So we'll wait and see when it comes to that. Coming over to the valuation dashboard. Taking a look at what we got in general. There hasn't been too many changes here. I did put Ulta here on the page, and I talked about this a bit last week, and I had said that I was working through the final kind of assumptions around the revenue model, but then I still knew that I had a lot of work to do in terms of thinking about the profitability. Well, I have done some work on their profitability, and I do now think that they're basically about fair value. They're slightly overvalued by my estimate currently, but that does leave not super great expected returns because of the generally high terminal multiple that they get relative to other retailers similarly, just because they do have a pretty strong competitive position. So low expected return. So the point is, yeah, fair value, but I wouldn't be snapping at it at this price point. At least my 25th percentile for them is in kind of the 340 range or something like that. It's below. Some of the people in the Discord were saying that they liked it around 325. I kind of concur on that kind of feeling personally, but we'll see. Maybe my feelings and assumptions will change around that too, and it's possible that I'll be making a video about this one in the near future, as I expect a lot of people are looking for Ulta Beauty valuation. So maybe I will have some more comments to say about that this week when my video comes out. So take a look out for that. Now, one other thing that I kind of wanted to talk about, like I said, before we get to actually talking about companies, so there's one other topic I want to briefly comment on, which is inflation. I know nobody likes hearing about inflation anymore as much, but we still got to talk about it a little bit. which is to say that, the month passed, we went into September. So I made my estimate for what I thought inflation was in the United States in August, which I have right here. And my assumption, or my estimate, is about 37 basis points, or so round that up to maybe about 40 basis points or so for the month over month movement. But the consensus number that the economists currently have is actually about 60 basis points, which I thought was interesting. You can kind of come over to assumption about that. So I would say that that's a little bit of a worrying sign when my estimate is already a relatively hot number, but the consensus estimate from economists is actually hotter than my number is itself. So if my number ends up being accurate, that means the year over year inflation would then be rising from, I think it's currently at around 3.2. It would then be rising up to 3.4, 3.45% or so on the year over year basis. And then that number itself, that 3.7 being annualized, if we got that consistently for the next 12 months on a forward basis, that would actually annualize up to 4.55%. So inflation is looking like it's rising back up a little bit. It may not rise all the way back up to 9% or anything like that, but it looks pretty likely that we're going to be going up towards 4%. I feel pretty confident in saying that it's pretty likely we're going to go north of 4%, or at least hit 4%. I don't know how much more north of 4% will go. Probably not all the way up to this or something like that, but and it's pretty much all off of the basis of rising housing costs. One of the things that goes into my estimate for inflation is the rental estimates that come from the Zillow rents. The Zillow listed pricing rents is actually one of the things that I list here, and they rose pretty significantly this last month. And since commodity prices have come to a pretty solid chill point pretty significantly over the last several months, that means the remainder portion that is still very hot is largely real estate. So that's the thing, is like a lot of what's going on doesn't seem to be having a huge effect on real estate. Real estate prices are still going up, rental prices are still going up. So this number is still going up, means that we don't have any reason to believe that it's going to turn around next month or the month after that or the month after that. It would likely take several months before we actually see several major changes there. Unless the rest of the portions that go into the CPI gauge go into significant deflation territory, we're going to see inflation going back up pretty sharply. So yeah, we'll see where it actually lines up. Like I said, maybe it'll be somewhere in between me and the economists. The halfway point between our estimates would be about 0.5. So we'll see where that goes. But inflation is looking kind of hot. And then connected to inflation, of course, is Jerome Powell. Jerome Powell, we're expecting another meeting on the 20th. So that's going to be like 5 days or so or something like that after that report comes out. So that report comes out in like 5 days. It's going to be a hot number. Hopefully it's less hot than expected, but less hot than expected, even if it's hot as I expect, would still be a hot number. And then 5 days after that, we're going to get Powell. It seems like not very much of the market expects a rate hike in this meeting. Everyone seems to be expecting a skip, and then we're going to be getting it next time. Now I was not believing the skip story the first time, and I was wrong. So take it for a grain of salt when I am here to say that I think that there's actually a good chance that Jerome Powell decides to do a rate hike this time. I think there's a good chance that he chooses to skip again as well. But it's possible that they could try to use the re-acceleration as a solid guidestone to say, hey, we skipped because we needed to wait for the data, but now the data is here, and the data is that it's getting too hot. I know a lot of people are like, oh, whatever, we're at the end of the rate hike cycle. It's like, guys, I don't know. I keep showing you the inflation data. It's like the inflation bottomed. Inflation bottomed 2 months ago, guys. I don't know what to tell you, but it bottomed 2 months ago. And it's possible that that bottoming is going to be the bottom for a while. So buckle up is all I got to say. It's possible that we're still getting more rate hikes. It's possible we're still getting more than one rate hike. My model for inflation had said that we were likely to get to a terminal rate of around 6.25%. I said that like in March or something. I think was like the first time I came up with that number or something like that. So obviously we're still short of that number, but it still would not shock me if we got to that number. It just might mean we're getting it there later than November, which is when I initially had said that. So, hey, like I said, good odds, I think, that he does still skip this meeting. It's still pretty good odds that he still skips this meeting. I think it would be a mistake on his part to skip, probably. Because inflation's re going back up. I don't know what to tell you. But either way, if he doesn't skip, then that means that we would have another hot reading before the next one. Luckily, the next 3 meetings all come relatively rapid fire. They're only like about 1 month after each other, a month and a half at the most, rather than some of the summer months where it kind of waits like a solid 2 months in between. So we get a few more rapid fire meetings. Of course, rapid fire meetings means we could get rapid fire rate hikes under certain circumstances. So all I'm saying is the economy still hasn't crashed yet, so he still technically can raise the rates and point to the low unemployment and point to wage growth and point to a functioning stock market and get away with it. And I would actually support that. I know a lot of other people are like, no, it's over. Jerome's got to stop. We need the rates to go down. I'm in the kill inflation at all costs camp. I'm in the kill inflation even if it means deep recession now camp, and I've always been in that camp. So let's just take that for what it's worth. I'm the type of person that does actually believe that it's like ripping a band-aid off. You kind of have to just get it over with. And even though it's a painful band-aid, but hell, I'm looking to enter the job market next year myself. So as a student who will be leaving school, so I'm well aware of just how painful it could be even for my own opportunities in the future. But nonetheless, I would still think that it's the best choice for the entire economy. But anyway, we'll get off the soapbox of that right there for the last couple of minutes. We're sort of turning that direction. But let's actually talk about companies now, as Mr. Beast wants. Although, like I said, we're not going to talk about Express yet, not quite immediately, because there is kind of a specific request that was made in the Discord and was asked about enough times. And I talked about it a little bit in the Discord already. I already looked at it a little bit, and I had kind of commented that I thought it was interesting in some ways. So I decided I wanted to look into it a little bit more. And I decided, fine, we'll talk about this company a little bit. So one of our viewers requested this. I believe he said he wasn't going to be able to watch live today. He was going to watch later. So here you go. And I can't remember your YouTube name, but Crit Damage in the Discord. I know he had a different name. Remember, he was one of the people who had a different name. But anyway, so this little company right here, Cliq Digital AG, as it says here, sells subscription-based streaming services that bundle movies, series, music, audiobooks, sports, and gaming to consumers worldwide. Out of Germany in particular, sells quite a lot of content to North America. As I was finding in the 10K, which was interesting because initially when I was first looking at that, I thought they were primarily focused on Europe, but then I found out that actually majority of their revenue does come from North America, which is kind of interesting. Licensed streaming content partners, bundles, and sells it through content through its various streaming services. So it's literally just taking licensed content onto its platform. It doesn't produce any of its own. It's just kind of an aggregator of all these different kinds of content. And obviously, it's kind of doing a wide variety of content. And I'll kind of point out to this kind of similarity because this is kind of like just how I was thinking about it when I was looking at the company a bunch earlier, which I only looked at it for like a couple hours, literally just this morning. So it's more analysis than I usually give when I'm just going over stuff on Ticker, but less than a full video or a full valuation. So just for what it's worth, as you'll see right here. But I looked into this company a little bit more than I usually do when I'm just looking at something on Ticker. Like I said, kind of at the request of the viewer. But anyway, what I was going to say is that this company kind of reminds me of early days Audible. It kind of seems to me like it's kind of got a similar mindset as Audible. Audible obviously sells audiobooks for Amazon. They were purchased by Amazon a long time ago, but I'm kind of even thinking like early days Audible. They were really just like trying to get as much content from like other places that people who can't seem to be getting enough revenue for the content, like books. Book publishers of all this content. Book publishers were getting hit really hard in the digital age. They're like, well, hey, why don't you license it to the audio and you can put it on our platform and we can sell it really cheap. And like the users of Audible in particular, it's the user behavior, I think, that kind of reminds me of it to a certain extent, is that users early on in Audible, and even to a certain extent today, weren't very loyal to the platform. A lot of it was really about just how cheap it was to get specific content you were looking for in some cases. Like you really wanted to find this specific thing, and this thing was the place that had it, and also had it cheaper than maybe some other place for some specific things. Or maybe there is some circumstances where you are in particular literally just looking for like the cheapest way possible to have access to some content, and the kind of irregardless of the quality, some levels too of it. Now, like I said, this is my impression, just kind of looking at this content. I literally have zero experience with this app, zero experience with their products. And in fact, when I was looking into the company to a certain extent, I had difficulty kind of even trying to even finding like uh too much consumer facing stuff for it, and that might have to do with the fact that it is based in Germany. But I can come over to the website a little bit and kind of like see some of like the way that their platforms look like. Um, and it's definitely a bunch of stuff that they have talking about, like the way that they license from different people and the ways they bundle different stuff together. But they unfortunately don't really give me too much information, both on their website and in the filings I was looking at, related to their customers. So I'll actually come over to look at the presentation, or maybe I'll look at just their annual filing. Well, we'll look at the 6 month presentation first. So here's the six month presentation. Looking at it, you can see, so right off the bat, we got 160 million euros in sales. Looking at it's all going to be in euros, so just kind of think in those terms. Don't really worry about the conversions. Think about ratios. Don't have to worry about it too much. 25 million in EBITDA, up 37%, up 37%. So good to see we see sales and EBITDA are up relatively in line with each other, so they don't have a crazy kind of cost scaling to that. Although they do have some questions about their costs that are kind of changing over time, but we'll get to that. Operating cash flows, the previous year it was in a loss, but it moved into kind of positive territory. That's good. It's the operating level though, so I'm not sure why they're saying operating than free cash flow. Usually operating cash flow and then free cash flow mean slightly different things, so I'm a little confused about the metric there. And then they do have dividend distributions, which I will say is like, I don't know, given their growth path, that might be a little bit of a risk factor to be trying to do payouts. Maybe it'd be better if they weren't doing payouts, in my opinion, but it's kind of hard to say. But yeah, so coming down the line, movies and series. Italy got 50 plus movies from Minerva Pictures, 70 plus feature films from CC United for Latin America, 80 plus movies from Inopia. So yeah, a bunch of different kind of like international studios, less not Hollywood type studios, just like other international markets, other places like that, as well as like they have a variety of other what looks to be international releases of more Hollywood movies as well. Some of these are Hollywood movies just translated. As well as like it sounded like from some of the data I was looking at, they do a lot of audiobooks as well, which is part of the reason that my mind started thinking about them in terms of like comparing them to early days Audible to a certain extent. But I do wish that they gave a bit more data related to their customers. That was one thing that I didn't like about it. I did note that they have added PayPal to their system, though, not to overly shill for a different company and a different position that I have allocation to. But go watch my PayPal video for more information. Uh, but yeah, so let's see. Coming down the line, let's some of the stuff about the region stuff. So here we'll talk about exactly what I was saying right here. 6 month in 2022, and then the first 6 months in 2023. You can see 57% North America, then 56%. Yeah, a little bit. I was actually sort of surprised to see as large of an amount in here, and it is separated off from Latin America. So it's not saying North America necessarily. I'm not 100% sure which category they're falling Mexico into. Sometimes you'll see them categorized as Latin America, and other times they'll just group them into North America because there's technically overlap there. So I'm not 100% sure where Mexico falls in that particular case. Maybe that skews the percentage, possibly, if they're categorizing it weird. But I kind of feel like they'd probably, if they have a Latin America category, it probably includes Mexico. So yeah, probably this means mostly America and Canada, but still kind of interesting. And then you can kind of see by service, most of their content is done through their bundled package. It's subscribed, and then you get through a larger bundle of the different products that they have. Now, not necessarily focusing too much on the actual financials, because I kind of just did some kind of spitballing as far as some of the financials go, but definitely been growing a lot, in terms of the total sales you can see right here. And then growing precipitously with that is the marketing spend being a huge factor for what drives their actual growth. And then customer acquisition costs. This kind of comes into one of the things that was being talked about, is that their customer acquisition costs have increased pretty significantly, as well as along with their growth. And that's one of the reasons I think that they've definitely been kind of languishing in price terms, is because there's some questions about whether or not their customer acquisition costs are going to go up over time. But the biggest question I really kind of have comes down to, like I said, the members. They don't provide a whole lot of information surrounding the subscribers and the members, but they do provide some information around the LTV, the lifetime of value for the members. So this is the amount of revenue that they're expecting to get from each member over the entire lifetime of having them. But that kind of leads to some questions in my mind, and maybe I'm just screwing something up in my thinking about this. I don't know. It's possible I am. But let's come over to their annual report where we can see some of those same figures a little bit more over time. Let me We have the paid memberships growing from up in 2019 upwards, hitting about 1 million in 2020, 1.3 in 2021, up to 1.9 million in 2022. And then we were seeing it as of the 6 months since then, it had then dropped to 1.1 members. So it went from 1.1 million members. Oh, go to this page. Yeah. 1.9 million members in 2022 to 1.1 in 6 months. So we had a huge drop off in just 6 months period of time. And then that would relate, I would say, to the lifetime value per customer as well. We were seeing the lifetime value per customer on this presentation showed it to be around 83 euros. And then in the annual, on this particular slide, it's not showing per customer. It's actually showing the lifetime value for the full customer base, but this grows over time. If you divide it by the total number of members, that gives you that lifetime value per customer, which I did build a kind of a brief little spreadsheet for them. Like I said, just in like the few hours this morning. So it's just a very kind of rough estimates of some numbers. I was just kind of thinking about this a little bit. And this is showing a little bit of a bull case, I'll say right off the bat too. So we got to think about this is that I have a lot of questions that make me not believe in their bull case, but here's a bull case for them anyway, and we'll see what that looks like. It's kind of what we kind of got going on right here. So we got numbers up to 2022. These are all like actual historical numbers, and then some of the numbers from the 6 month period I included as the 2023 numbers, specifically down to 1.1 we have listed here. One other thing I wanted to comment on, I don't remember where it was, but somewhere on their website I did see another spot where they had said 1.3 million. So it's possible that maybe even since that 6 month period they had updated it a little bit, and maybe it's up to 1.3 now. But nonetheless, still down to 1.3 from 1.9, which is like a 42%. We were seeing 50% growth in members in 2020, 44% in 2021, 46% in 2022, and then a 42% decrease in this first 6 months of 2023. So it's huge worrying sign, huge worrying sign. Now they themselves also have, like I said, there was the lifetime of value per member. So I wanted to come over to the spreadsheet so I could break that down for you, where they were showing it as being around 70 and change or whatever. And then I'm seeing it as being subtracted pretty significantly since then, because they're in the last, the last expectations of the last year, the total lifetime value has dropped pretty significantly as well. So the question is like, where is these numbers going to go? It's like this. The question is the members are going to grow at a certain rate, and the total amount of revenue that you're going to get from each customer is going to change at a certain rate. Now, what does lifetime value per member mean? As I was kind of already saying, it's the total amount of revenue you're going to get per customer over their lifetime. And the question is how long is that lifetime? Now we can kind of take a look at it, and the fact that we saw it go from 1.9 million subscribers to 1.1 million in 6 months should give you an idea of just how fast those subscribers are evaporating from the platform whenever their needs aren't met. In fact, that almost gives us a ratio for which we could do it. We saw half of it disappear over a 6 month period. That would almost imply like a 1 year lifespan. Now I chose to do a little bit of math on this, and I took the actual lifetime value that they give, and then divided it out by the members, and then took a ratio of that, so that for 2020, 2021, and 2022, we could see that the total amount of years that was being implied by the lifetime value that they supplied with us was 2.1 years, 1.7 year, and 2 years. The average of which for those 3 years ends up being 1.9 year. And then I then divided it out, that lifetime value, by those years, and then by the amount of months, and then it gets us essentially the amount of month that's being spent or the amount of money that's being spent per month per member on the platform. And over, like I said, the last few years, it's on average been kind of in this like what, $270 to $80 range. Most recently at the end of 2022 it was a little over $3. And in 2023 it looked like it had dropped below $3, but not necessarily super precipitously. So the amount of money being spent isn't necessarily dropping too much. It was mostly the members, which means we have to worry about this churn effect. The lifetime of a member seems to be about 1 to 2 years. 1 to 2 years is not very conducive to growing your subscriber base over time. Now, the company themselves provides some outlook on the website, where they seem to believe that within like 2 years time, they're going to be able to get to upward, their revenues upward, to get it. I think they, what was it? I can't remember. I think they had, was it 300 or 400 million euros they're expecting to get to? Oh, hold on. Should have wrote down in the 500 million. 2025, the 2025 estimate is 500 million euros that they're expecting to get up to. But like I kind of struggle to figure out how they expect to get there, to be fully honest, to a certain extent. It's like in 2022 they had 276 million, but again, if I like divide the that revenue by each amount of users, that ends up being $145 per member, but that doesn't really make sense with the lifetime value numbers that they're giving me. So it's like, I don't know, it doesn't make sense to me how they lost as many members as they did in the first 6 months, and yet they still expect in 2 years time to then jump up to 500 million. I don't know. So anyway, in this model, I did still get them up to those levels, but I saw them getting there in literally like 10 years time. And I did that just by throwing some numbers together. These are literally just some random numbers, so take it with a huge grain of salt. Like I said, I did very little research on this, just a couple hours of kind of looking at some numbers here. But I was like, okay, they dropped 40% of their subscribers in 6 months. Let's assume that that pain doesn't end actually for a couple years. Let's assume that maybe they have a little bit of some drag for a while before they start to really figure out how to keep their members. And then once they start to keep their members, maybe they'll start to actually take off a little bit. And then I have them getting all the way up to 3 million members in 2031. It's kind of sticking in that range of the 2032, 2033, the full 10-year range. Like I said, totally made up. It's based off of almost nothing. I haven't really looked into the total market size and like how they're going to penetrate it or anything like that. Because like I said, it's like I honestly just am looking at their history, and the way in which they collapsed in the last year doesn't give me a whole lot of confidence. So I didn't really feel like I needed to do that much more research on it. But then beyond that, I was like, okay, well, let's make some estimates about the lifetime value per member. We were seeing decreases of that even while they were growing, but then some increases while they were continuing to grow, and then decreases over the course of the year to a certain extent. So I'm like, well, maybe we'll see kind of in general similar numbers. So like one way I kind of thought about this is that the historic period time frame I have right here, on average for the member growth, it was 25% in a given year. So the average for any given year of the 10-year period I went with was about half that, 13%. I did kind of the same logic for the LTV. Again, super rudimentary, basic number thinking. There's nothing logical super about it other than just slowing down the growth rates. 6% on average for these 3 years. So over the period that follows it, I have it be like 2 to 3%. Not counting kind of this decrease in 2013. I kind of discounted that, and that gets me to 2 to 3%. But so just kind of some base estimates about how these numbers could grow, and then those numbers led me upwards towards around 500 million in euros in 2031, 2032, 2033. But it takes all the way up to that point for me to get to those kinds of revenues. In fact, I kind of see their revenues collapsing in the near term. The idea of them getting to 500 million in 2025, I feel like they would have to get to 3 million members in 2025 to do that. And that's possible, I would say, because I mean, they did go from 0.6 million members to 1.9 in 3 years time, so it's like it's possible for them to do it. It feels like it's just as likely that they go the other way. That's part of my issue with this. I don't see what their what benefit they're providing their members that the other platforms can't otherwise provide them, which is why I think that they tend to churn out as fast as they do. We're seeing this 6 month, 1 year, 2 year churn because of the fact that they're not really giving them a long-term value. So then beyond that, that's just revenues that I kind of projected out on this line right here. We also have their EBIT margins that they've had over the last 4 years that they've kind of listed, or 4 or 5 years that they list historically. I chose to kind of just take an average of that, and that gets me 11 to 12%, a little bit lower than the most recent EBIT margin. So I think it's a reasonably conservative estimate. It might even be high, I don't know. But the point is, that's what I chose to kind of make an estimate with. Use a 25% tax rate. They have 6.5 million shares or so. I chose to increase that to about 7 million to account for any equity dilution that I'm not aware of. I didn't really want to look super closely at it. But that could be an overestimation, but nonetheless, just a conservative estimate. And then so with those assumptions, I break down to essentially an assumption for EPS over the continuing time frame. I use a 15% equity discount and terminal growth of 1, and we get our discounted cash flows with the terminal value. I end up with present value of $26.03 per share. Euros. That's 26 euros and 3 euros per share. We're currently trading at around 20. So that's kind of like, I don't know, like I said, a pretty optimistic, I would say, valuation. If I was to apply a 75% margin of safety onto that as well, to, because that's fair value with those assumptions, then I would maybe want to get it at 1953, which is, you know, pretty close to its actual current price. So you could argue that buying it right now gets you a pretty good margin of safety, assuming they can actually hit pretty strong growth. But like I said, my criticisms is that I don't really know why I would feel super confidently that they could hit these targets necessarily, or even that they could continue being a fully functional company past this as well. Like I could see them maybe rising to 3 million in the next 5 years, and then maybe dropping to zero over the next 15 years after that, right? So at which point we wouldn't want to be using terminal growth rates of -1%. We might want to be using terminal growth rates of like -3, -5% or something like that, you know, like they're to imply that the company is in fact going to go out of business in like 20 years time or something like that, which would lower our estimates even further. So, you know, like I said, it's like this, these are just some spitballed assumptions that I threw out here. I hope Create Damage likes the analysis. I know it's not going to be super pleasing to hear necessarily. I know he's kind of bullish on this one. But like I said, like there's reason to be bullish if you are confident in the growth path. If you strongly believe that they're going to continue to grow members and that they're going to be able to at least improve the total amount of dollars that those members are spending on the platform, then there's a real opportunity here. It's just I don't know why I would bet on this one over any other one necessarily. That's part of my issue with it. The skew of value is not good enough in my opinion for those types of assumptions. And of course, you could also quibble with some of the assumptions here too. If they were a bit more successful here, it's possible you could argue that the discount should be lower to a certain extent. Like you can quibble with a lot of the assumptions that I used here. Obviously, that's always the case with DCFs. But point is yeah, I don't know. It looks like it's at least of a reasonable value. That's what I will say. It's like it looks like it's a pretty reasonable value, but it doesn't necessarily look like it's a great fundamental opportunity in terms of the quality of the business. I don't know. I just don't know hardly anything about this company. Everything I know about this company was revealed to me in the knowledge of this particular investment and in looking at their documents. Like I've never heard of anybody using their products, so maybe that's part of the reason I just have such low confidence in it. But yeah, so that's my brief overview of Cliq Digital. Hope that was satisfactory for the person that requested it and anybody else that would want it. What else we want to look at? Mr. Beast, Express. We're looking at Express again. Are we looking at Express again? I mean, again, I don't know what else you necessarily want me to say. I can't give you much more else without going deep on it a little bit more and looking at it. And I'm not going to do that on stream. I might do that at some point in the future, but the point is, I can't do that deep of an analysis on stream other than what I've already done before. And what I've already said before is that, you know, it's not profitable currently, so we don't have a valuation for it in that terms. I like the brand, as we said before. I remember it needed to kind of reorganize its balance sheet after it was casting off some assets. We'll see if I think they reported one earnings since we last talked about them, right? So maybe the balance sheet looks a little bit different now. How many analysts we got on them? Not very many analysts on them, unfortunately, which of course is to be expected with small companies. By the way, if you're watching live on the replay, please like the stream. It'd be really appreciated if you like the stream. It helps attract more viewers to the channel. Please subscribe if you're not already. Please consider joining the free Discord. Link is in the description below. It's also the pinned comment in the chat. And join, be part of the daily discussions of what we've got going on in the markets, what we got going on in our own portfolios, what's happening with some companies that we're analyzing, actions of major investors and things like that. So come be part of the discussion there. Also consider checking out the other content that I have on the platform, like the Encore Wire video that I put out. If you haven't watched that already, go check that out. And then, as I was kind of hinting at a little bit earlier, I'm expecting to put out an Ulta Beauty video this week. So make sure you have the notification bell ring as well. That way you get notified whenever I go live. So take a look at the balance sheet. You know, the 59 million in cash we got currently. They still got 650 million in debt, including capital leases, which you should. So still a pretty significant amount of debt. Their cash flows. Let's see what's happening with their cash flows. Still massively negative cash flows on the operations. There's huge other operating activities, which I'm kind of curious about. But usually that's kind of like more of a relatively one-time thing if you're dealing with that type of other operating activity relative to inventories or payables or something like that. Not necessarily. It depends on the company though. So we'll see about that. Yeah, rolled over a bunch of their debt. So it's like, I mean, the cash flows should, bounce back pretty significantly once that part gets rolled out. If we were essentially just to ignore this one part right here, or I don't know, maybe it's not good to ignore it. Let's think about maybe what the average would be. -50, -100. Let's say -100. That's sort of like maybe a base average. So then that would be 300 difference there, which would put free cash flow in the like 100 million kind of range at that sort of assumption. But then, yeah, 100 million maybe. How many shares outstanding that they have? Say 4 million. Is that accurate, or do they have huge dilution amounts that I'm not tracking? Looks like Mr. Beast disappeared from the chat when I finally reached his request, but this is usually the case. Come on, Mikey. Come on. Come on. That's being super antsy. Yeah, so I mean, as I have said before, I am somewhat interested in looking at this one. I can't necessarily say too much about it more than I've already kind of said, other than yeah, it sort of looks cheap. It just looks a little bit like it's got a bit of a debt situation to deal with, much like many other retailers. But I mean, they're not in a terrible scenario once they can deal with, like I said, rolling off of those kind of excess other expenses that they had in the most recent years. Like once their cash flows kind of come back to normal within the next year, that should put them in a position where they can start to normalize everything. So, but until I've like really looked at what stores they're looking to keep in the long term, or what they're looking to expand to, if they're looking to do any of that, it's hard for me to say too much more. That's just the difficult part. And it's just difficult because partially they're unprofitable right now. It's like, yeah, they definitely look super cheap though, no doubt about that. Because yeah, as you kind of pointed out in the chat, so we got like 44 million market cap, or 34 million, my bad, 34 million market cap. The enterprise value is huge though, so that's the thing. It's like, yeah, we got to take into account the debt. They do have, I think that number seems a little bit weird, but they do have a bunch of debt, so it's not actually, that's not, that 34 million is not actually what you're paying to get the free cash flows. You're paying this to get the free cash flows. But the free cash flows still look pretty good. So that's the thing. It's like, it still looks cheap even when you take that debt into account. Um, but it's hard to say just how cheap, because they're trading below their operating cash flows. The best ratio I can get to is an enterprise value to revenues, which we can see right here, that they were in fact even cheaper in 2018, 2019 on that basis. But of course, if we show what was going on during that time, they sure don't look like they're cheap relative to that, right? So yeah, I mean, like I said, I am interested in this one. I am interested in it. I just haven't gotten around to it because I don't consider it a super growth opportunity, as I was kind of getting with earlier. It's like I'm trying to focus more on this quadrant, whereas Express would be probably more around here, right? Here, maybe close to the middle. This is kind of the range where Express is, and I'm trying to aim more for these opportunities. So, which is part of the reason, like I said, we built this kind of framework of thinking. Is like, this is how we're trying to think about the stuff that we want to allocate more of our money to, but not just our money, our time. we're more than willing to take opportunities in these other buckets, just so it's clear. But the opportunities have to be large, skewed large. As I was talking about earlier, like there's urban grow is that other kind of speculative, non-profitable opportunity I'm very much looking at, but that one has huge opportunities in front of it. Express, they probably could have some huge growth opportunities for them. Express, it's possible Express could expand a ton, but they would have to do it at the expense of so many other companies and brands and market shares that it's harder for me to see them as really winning, right? It's not like their whole industry is growing in some massive fashion. Uh, uh Pun there, right? Because fashion industry. But clothes are clothes. People can only buy so much clothes. Like, yeah, they spend more money on clothes maybe, but there's only so much clothes that are going to be bought. Whereas like other industries are like actual growing industries. So it's one of the ones where it's just like I'm just not enthusiastic about the industry. The brand is pretty good. The company looks cheap. I'm just not enthusiastic about the industry. So it's kind of taken me a while to maybe actually start looking at their stores and like how much revenue per store they're doing and stuff like that. Like that's really the next level. That's really the next level I have to get to. But yes, there's no doubt this is cheap. Definitely not arguing with that. So there's my thoughts on Express. Again, like I said, I don't have too much more that I can really say without getting too much into the nitty gritty. And like I said, I got into some of the nitty gritty today in Cliq Digital, but that was partially after enough pestering specifically about it in Discord. And of course, you have pestered me about Express, but like I said, I haven't gotten around to it because I'm less enthusiastic about it. Cliq looked like maybe there was an interesting growth opportunity there, so I was kind of like, we'll take a look at it. Like I said, I probably will get around to at least doing a basic valuation for Express. I'll probably try to throw it on the potential page at some point. Just not, it probably won't get a full model necessarily. Unless it looks super interesting. Maybe. I mean, that's always possible too, but we'll see. We'll see what happens with that. So that was my thoughts on Express. Anybody else got another taker? Relatively quiet chat today. We're up to an hour and 11 minutes, admittedly, so don't have to stick around forever necessarily. Like I said, I'm looking to finish up my Ulta analysis. That's the company I'm most likely doing a video on this week. Looking at some other companies and other opportunities as well. Um, I've mentioned Urban Grow a couple times today, but I really do kind of want to build a full model for that one. Just because I do think it has an interesting opportunity to it. I don't know if that would do very good views as a video necessarily. I don't know if it'll get a video per se, but interesting about that. And then I've been paying a lot more attention to a lot more macro analysts on certain subjects. And so I know I've been talking about commodities a lot, but I'm still super on the commodity train in a lot of ways. Very focused on energy and agricultural commodities, including agricultural inputs, as we've discussed a little bit before. Still looking at ICL and trying to decide maybe if I would take a short-term, more pricing-based position on ICL, perhaps, but haven't kind of decided about that. Other companies that were kind of thrown in here too, Movado, which is another retail apparel kind of company, which I don't know, maybe I could do a basic one of Express and then kind of compare a little bit between the two. I still never got to take another look at Canadian Solar after their recent huge declines, which put them into pretty respectable return potential territory. So I really ought to do another kind of re-up look at them. But from my understanding, their declines were based off of some real concerns. So those concerns have to be taken into account with the valuation. And then Jackson, I mean, that's another one that I've had this one in the portfolio on a kind of a pricing basis for some time. And it's actually done okay. It's already up a little bit. I think we're up like 15% on that one or something before dividends. And you know, I might have to do a little bit more thorough analysis to try to decide where an exit position would be for me on that. Because like I said, it's without a full model. So whenever I have a company without a full model, that implies that I'm going to allocate less to it, as we kind of already covered with our allocation system earlier, but also generally hold it for a shorter period of time. It's like pricing and workouts are usually about holding for like less than a year to 2 years, whereas full valuations I'm generally have with the mindset of holding for 5 to 10 years, generally, right? So the point is, if I enter into a position and I don't have a full model for it, it's kind of implies that I have a shorter time horizon assumed for it potentially. Good examples, obviously, being, like I said, the two that are marked here, Jackson and Spirit Airlines, one of which is a corporate workout, a merger opportunity. And the other one is just an interesting, what I consider to be price anomaly that I have some reason to believe would correct itself a bit over time. And also the dividend yield that they gave me confidence that I could sit on in the interim. So I guess that's going to be some of the last few comments here today. Very quiet day today, but luckily I had a lot of interesting kind of stuff to talk about surrounding, like I said, changes in strategy and focus around my portfolio. As I said, while we're kind of trying to think about our companies now in buckets, these buckets of increasing, cyclical, flat, and decreasing, of which, as I kind of mentioned before, this is about the volumes of the products and services that are being sold, not about the actual revenues themselves or about the earnings or anything like that. It's about the volumes of the products and services being sold. So we're stripping out pricing of which we think is more a function of the competitive strength that they have. This is more about who can sell what, you know, and how much of what, and how much of it is growing over time. So I'm happy with this kind of new system for categorization. I'm happy with the way it worked out into the new system for targeting and how that played out into the actual targets themselves for the companies. It definitely reflects the way I think about my positions currently. We'll see, like I said, over time, whether or not that remains to be seen. In general, every time I change my targeting system, after a few months, I start to notice some of the issues that I don't like as much about it. So we'll see how that changes over time. Maybe 2 or 3 months from now, I'll feel like I need to make some more changes. But for now, I'm pretty pleased with the changes and the results of it. So we'll definitely be buying in the market this week to work towards these allocations. Specifically, I definitely think I'm going to be buying a little bit of Generac and probably a little bit of PayPal. We'll see. We'll see what happens beyond that. So that's going to do it for the valuation today. I'll ask one more time before people go, whether you're watching live or on the replay, please like the stream. It would really help us. It's the best way you can show your support and really help attract more viewers to the channel. Please subscribe to the channel if you're not already. Hit that notification bell if you haven't already. Join the free Discord. The link is in the description below. It's also the pinned comment in the chat. Join to be part of all the discussions that we have going on there as part of our community. And keep a lookout for other content that I release. Like I said, this Friday, I'm expecting to have my Ulta Beauty valuation video out. So hopefully you guys will be watching that. Hopefully you guys will like that. And I'll catch you all in the next live stream next week. Bye.